Welcome back to AlgoBot, the channel where we take apart automated trading strategies and study how they actually work, line by line. I'm your host here at AlgoBot, and today we're exploring an expert advisor for MetaTrader 5 called Drift Contrast Regime Shift. This one borrows a tool from classical statistics, Welch's two-sample t-test, to detect the exact moment the market's drift changes character. By the end of this video, you'll understand how it contrasts two windows of returns, how it enters and exits, and how it manages risk. This is educational content only, so let's dig in. So what exactly does this expert advisor do? At its heart, Drift Contrast Regime Shift is a trend-following system with an unusual detection method. Most momentum systems ask a one-sample question: is there drift right now? The trouble is that a strong, already running trend answers yes on every single bar, which tends to make those systems interlate and give a lot back. This strategy asks a sharper question: has the drift just changed? To answer it, the EA uses Welch's two-sample t-test. It contrasts two back-to-back windows of returns and measures how far the recent drift has separated from the prior drift. When that separation becomes statistically decisive, the strategy treats it as a regime shift and looks to trade in that direction. It can be applied to any symbol and any time frame, because every calculation references the primary chart you attach it to. You could study it on a major currency pair, on a metal, or on an index. The logic is identical. It trades both directions symmetrically, with distinct long and short rules that mirror each other. Who is this style of approach suited for, in an educational sense? It's built for traders who are curious about statistical, rules-based systems, and who prefer a design that waits for a clear transition rather than chasing every wiggle. It layers a slower trend filter on top of the statistical signal, so that shifts are only taken when they agree with the broader regime. And it puts heavy emphasis on drawdown control through ATR stops, a break-even move, and a tick-by-tick trail. Remember, none of this removes risk. Trading always involves the possibility of loss. We're studying how the mechanism is built, not making any promises about outcomes. Let's walk through the mechanics step by step. The strategy works entirely on a single time frame, whatever chart you attach it to. On each completed bar, it takes the closing prices and computes logarithmic returns, which are simply the bar-to-bar changes expressed in a way that adds up cleanly. It then splits those returns into two adjacent windows of equal length, set by the window parameter, which defaults to 20. The recent window holds the last 20 returns. The prior window holds the 20 returns immediately before that. Welch's two-sample t-test compares the average drift of the recent window against the average drift of the prior window, scaling the difference by the combined variability of both windows. The result is a single number the code calls the contrast T. Here's the key idea. A steady, established trend looks the same in both windows, so the contrast reads near zero. Nothing new has happened. But when drift suddenly shifts, when a fresh up move ignites out of a decline or chop, the recent window separates sharply from the prior one, and the contrast T jumps. A large positive value means the recent drift has turned significantly more bullish. A large negative value means it has turned significantly more bearish. Now the rules. The strategy signals along only when the contrast T makes a fresh cross above the positive threshold, which defaults to +2, and only when price also sits above the slower trend EMA. Both conditions must agree: the statistical shift and the prevailing regime. It signals a short in the mirror image, a fresh cross below -2, with price below the trend EMA. The system uses stop-and-reverse logic. If it holds a long and an opposite fresh cross appears, it closes the long and opens a short, and the reverse for a short. There's also a dissipation exit. If the contrast decays back through zero against an open position, the edge is considered gone, and the trade is closed early. Risk is defined by the average true range. Every trade gets a stop placed at 1.5 times ATR from entry, and a take profit at 3 times ATR, a 2-to-1 reward-to-risk structure. Once a trade travels 1 R in its favor, the stop is moved to break even and then trailed by 1.5 times ATR on every tick, so open profit is protected continuously. It holds one position at a time with fixed lots. Let's look at the actual MetaTrader 5 code driving this. At the top, you can see the input parameters. Window sets the length of each of the two contrasted return windows, defaulting to 20. TStatThreshold is the band edge, how decisively the drift must shift before a trade is considered, and it defaults to 2. Trend EMA period is the slower moving average that defines the regime at 50. Then ATR period, AtrSL multiple, AtrTP multiple, and AtrTrail multiple govern the stop, the target, and the trailing distance, all measured in average true range. Lots is the fixed position size. Below that, you can see how a fresh cross is detected. Cross up is true when the previous contrast value was at or below the threshold and the current value has just risen above it. Cross down is the mirror, the previous value at or above the negative threshold and the current value now below it. Now the two signal blocks. On the long side, if cross up is true and the regime is up, meaning price is above the trend EMA, it closes any short and enters a long through the triangle call. On the short side, if cross down is true and price is below the trend EMA, it closes any long and enters a short. Down in triangle you can see the orders themselves. For a long, the stop is entry minus 1.5 ATR and the target is entry plus 3 ATR sent with trade.buy. For a short, those distances simply flip, sent with trade.sell. Clean, symmetric, and fully rules-based. Let's bring the whole thing to life on this illustration. On top you can see a series of candles with the slower trend EMA drawn through them. And in the panel below sits the star of the show, the Welch contrast T oscillator, centered on 0, with a threshold line at +2 and another at -2. Watch the left side of the chart first. Price is drifting lower over the first few candles, sliding down toward a fresh low. Look at the contrast oscillator underneath during this stretch. It's sitting in mildly negative territory, but notice it isn't extreme. That's the important subtlety of this method. A steady, orderly decline looks similar in both the recent and the prior window, so the contrast stays muted. Nothing new is happening yet, so the strategy stands aside. Then comes the turn. On the reversal candle, price stops falling and pushes back up with a strong bullish body, and it closes back above the trend EMA. At that exact moment, the recent window of returns separates sharply from the prior window. The drift has genuinely changed character. You can see the contrast oscillator leap upward and make a fresh cross above the +2 threshold. That combination, a fresh up cross with price now above the trend EMA, is the long condition, and the buy entry marker prints right there on the reversal candle. Now follow the trade. With the long open, the strategy places its stop below at 1.5 ATR and its target above at 3 ATR, that 2-to-1 reward to risk shape we discussed. Candle by candle, price climbs. A higher close, then another, riding the fresh uptrend. As it moves, notice the contrast oscillator actually easing back down from its peak. That's expected. Once the new trend becomes the established trend, both windows agree again, and the edge naturally fades. Because the trade has traveled past 1R, the stop has already ratcheted up to break even and begun trailing beneath price. A few candles later, price reaches the take profit marker near the top of the run, and the long is booked. Now watch the right side, where the mirror image unfolds. Price stalls at the highs and rolls over. On the sharp down candle, price closes back below the trend EMA, and in the panel the contrast oscillator drops and makes a fresh cross below the -2 threshold. Recent drift has turned decisively more bearish than before, a bearish regime shift. With price below the trend EMA and that fresh down cross confirmed, the sell entry marker appears. From there the short works, just like the long, in reverse. The stop sits above at 1.5 ATR, the target below at 3 ATR. Price steps down candle after candle. The trail follows once the trade clears 1R, and price finally reaches the lower take profit marker. And if instead the contrast had simply decayed back through 0 while the trade was open, the dissipation exit would have closed it early, the moment the statistical edge disappears. 2 clean transitions, 2 symmetric trades. Let's wrap up. Today we studied drift contrast regime shift, an MT5 expert advisor that uses Welch's 2-sample t-test to detect the moment the market's drift regime changes, enters in the direction of that shift when it agrees with a slower trend EMA, and manages every trade with ATR-based stops, a break-even move, and a tick-by-tick trail. Remember that everything here is for educational purposes only, and is not financial advice, a recommendation, or a solicitation to trade. Every strategy carries risk, and losses are a normal part of trading. If you found this breakdown useful, please like the video, subscribe for more MT5 strategy analyses, and leave a comment telling us which strategy to examine next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.